Hey y'all, this is Sunday morning and this is going to be a video about how I pick options to play my Theta game strategy on. So as you know, if you follow my series, is that I've been doing the Theta game strategy where I sell cash secure puts every week. Now this is strategy surely is pretty safe, relatively safe, and for the most time, if you follow the study recently, is that you're going to profit about 80% of the time. So far, of those that I've closed, I have about 12 wins and 1 loss. And I closed this one when I was wrong. But as you can see, the profit's pretty consistent. And they're relatively safe in a way. So people usually ask me, so how do you find these stocks where you can play your cash secure put strategy on? Well, this video I'm going to show you why and some of the reasons that I pick a couple of stocks where I can make my plays on. So one of the first and biggest requirement is that this stock needs to have a relatively safe beta value. So if you don't know what beta value is, a beta is the movement of the stock relative to the S&P 500. So if the S&P 500 moves $1 and this stocks move twice as much, that means it has a high beta value. So you want to pick something that's pretty smooth, relatively slow moving, not that much daily movements. That would be a stock that's safe to play. So for example, last week I played Fastly and AMD. Now they're about the same price for the stock. One is $94, one is $85. Now Fastly, it was at $82 like a couple of days ago. So as you can see, Fastly moves much faster and bigger than AMD because Fastly has a high beta value. So given any given day, Fastly is going to move up or down like $5 or $6 in a day. Super stressful. I managed to play a couple of Fastlys. Now the thing is, when I play these, yes, the profits are good, but behind the scenes, you don't see how much stress it put on myself, because every day I will either be really far away from my strike price, which I'll be happy about when I sell puts, or Fastly goes really close to my strike price, which I'll be like pretty stressed about because I might get assigned to it, and then I'll be forced to buy 100 shares, and then what if the stock goes down another $5? I'll be down $500 right away. So it really depends on like your style investing, but for me, I like to be safe, even though they will cut my potential profits. But consistent small profits is the key to how to win in this market. So that's the thing. You want to pick something that's like relatively stable. So AMD is pretty stable. JP Morgan is kind of stable. You want to pick big companies like Nike or Apple. Not Apple. Yeah, Apple. After it splits, it's going to be around 100 something. So you can probably play cash secure puts on it if you want, or spreads if you don't have the cash. So that's the first requirement, is that the stock needs to be stable. Should not have wild movements. Now the next thing I do is I want to make sure when I pick something, I want to make sure I look at the stock fundamentals a little bit. I want to make sure that they have good rating first of all, and then they have good EPS. I like to play companies that are profitable and they have good fundamentals behind it. So Fastly is something like I was interested because I use the technology daily. And then the other requirement is that the stock needs to be on an uptrend. I do not play cash secure puts on a stock that's that's wildly swinging or that's not on an uptrend. So Fastly has been on an uptrend all year. As you can see, you can still draw a line for the uptrend, even though after the earnings last time it's been dropping like sideways. Sideways is also great to play also if you can identify good supports for it. So on a Fastly stock, for example, you can see that there's a really hard support at $72. So you can play it like that if you want. When Fastly goes up to around like 90 something, $100, it will probably drop down again. So anything that can go sideways and on an uptrend, that's a winning pick in my mind. So if you're gonna play cash secure puts, that's something you should look for in the charts to make sure that it qualifies. Now the third thing I look at is the sentiments of the users. Usually before I buy, I want to see what people are saying about this particular stock. And as you can see from the StockTwits ticker here, a lot of people are talking about the TikTok deal because TikTok is Fastly's biggest customer. So whether the deal goes through, it will affect the price of Fastly. So this is very important to me because sometimes when you see a new stock, you don't really know what the stock is about or any news related to it. So that's why this widget here, StockTwits, is very important to me. So it tells me exactly what there might be some news coming up or what the reason is for a certain stock to drop or to pop. So it gives me a really quick look. And then lastly, the most important part is that I need to look at the sweeps, the options flow for this particular stock. Why? Because with the options flow, it tells you what the big players are doing, right? So for me, I play weekly options. So I sell weekly cash secure puts. That means it will expire either this Friday or next Friday. So I don't tend to hold it long. I need it to be short term where my probability of success is easier because it's a lot easier to predict what the price is in the short term than long term. So I look at the scanners for the options flow for Fastly, let's say for example. I like to see things that are expiring this Friday and how much money people are putting into it to bet the direction of it. So usually when I see that, like here, you get a couple of puts, $82 put for next Friday. For Fastly, there's a 16% movement, $73,000 order. So these are big order. Here's a 436,000 order for October 16, $95 put. So that's near the money, but you have to look at these and then do your analysis because these are very important to factor in your decision to where you think Fastly is going to go in the short term. So for me, let's say I sold a put for next Friday. I need to make sure that these orders here, like this one that expires in the near term, this one also, that's a pretty big order. So the widget here will highlight it for me if there's a big volatility over open interest ratio. And then here you gotta buy. So you have to factor in these information before you place your order. So that's the pretty important part. Now, one of the things that you must take account into is the IV value. So here I have the Rocket company, which has been on a tear lately because everybody on Wall Street Bets is talking about it. Even Jim Cramer pumped it up recently. So as you can see, as the price rises, the IV value goes up as well. So if you got a put for it, if I'm going to sell a put, if you look at this Rocket company, look at this. So right now it's trading at 28. And even a $5 difference, if I go down to $5 difference, that's $23. You still like expiring next September 18. So that's in like 2 weeks away. You still get a relatively nice premium for it. As you can see, implied volatility is 128%. So this means people are expecting this to have huge movements in the short term. And if they want to like guard their investments, they will usually buy it and bid this up in order to protect their investments. So as a put seller, you want to make sure that when you sell puts, that the implied volatility is super high. The higher it is, the better, because you are pocketing in some of the premiums related to the IV. And when that happens, you pocket the premium, and if the price doesn't go that low, you get to keep all that money. So when the volatility is lower, you don't really want to sell it because there's not much extra money coming from it. Now the other reason is that this IV is so high is because you have earnings in 3 days. So for Rocket Company, you get 3 days until earning. Usually the implied volatility goes way up. And the last rule I follow is that I don't sell any puts that are going to be near the earning states. The reason is earnings can go either way. It could either go way up, in which you make your money, will go way down, in which you are forced to buy the stock at a certain price. So if Rocket wrecked their earnings in 3 days, and then the price dropped to $20, but then your strike is 23, you're forced to buy 100 shares at 23. So instantly you're down $300. So that is not something I'm willing to do. So I always look at the earnings date in the trade for widgets to make sure that, you know, it doesn't go into the earning as my action expires. So I hope you learned something from this video. The tool I use is something we built in-house called Trade4, and it'll give you a lot of this information for you to evaluate your decisions, to help you make your decisions. So I hope you find this video useful, and like and subscribe if you want to see more.